Good morning, and many thanks for joining this morning's briefing on the preliminary Q4 2020 national accounts and international accounts results, and the first view of the results for the year 2020. We've set all of your microphones to mute and we'll keep them on mute as we go through the presentations on today's results. But we'll have time at the end, hopefully, to take some questions. And could I ask people to use the Q&A function for the questions, or if you put your name in the chat function, we can take you off mute and you can talk to us with your question. In the results today, you'll see the COVID-19 related restrictions have had an impact in every quarter of the year 2020. We saw the contraction in GDP in the first half of the year, followed then by expansion in Q3 as restrictions were eased. With the publication of the Q4 results today, we have that overall picture for the year, and my colleagues will take you through the annual and quarterly overview in this morning's slides. Just to note that today's national accounts release comes to you in a new format and now includes new information on the M&E dominated sectors, previously a separate publication by CSO, but we've now incorporated that information in the main quarterly national accounts publication. And there's also some new quarterly detail included on compensation of employees. Chris Sibley will take you through the background and the detail on that in the slides this morning. And those slides are available on the CSO.ie along with the releases, and hopefully we'll be able to put a recording of today's presentations on the CSO YouTube channel. And as always, what we always say is users can contact us at any stage with queries on the statistics, on today's statistics or on any other results we publish from CSO. Contact details are available on our statistical releases, on our press releases, and on the website. So I'll pass to Chris Sibley and John Sheridan to take us through the results. Chris will take us through national account results for 2020 in Q4, and then John will take us through the international accounts for 2020 in Q4.
So as Jennifer mentioned, we have a new format quarterly national accounts publication for you this morning. We've taken it from what you were used to as a single page release with all tables underneath it into what we in CSO call a chapter style publication. So it has buttons on the right hand side for you to navigate through the information. So you can more easily find the income, expenditure and output methods data in the publication. So we've GDP by sector on the right hand side to show you the NACE sectors, GDP expenditure, showing you the personal consumption, government expenditure, investment and net exports. And then we have a chapter on domestic demand. So one of the key features behind the publication is make it more accessible for you to find the modified domestic demand measures now with its own chapter. It's giving us a bit more space as well to do more charts and analysis for you in this chapter style publication. As Jennifer mentioned, we've two new chapters in the publication. One is a release, an M&E dominated sectors release that normally comes out in a couple of weeks' time. We've brought that forward. So you can see a decomposition of growth in the economy at now at constant prices into foreign and domestic data. We also have a wages or COE chapter. I'll talk a bit about that towards the end of the presentation. So I guess the big picture today is that we've got the fourth quarter results for you, finishing off the year 2020. And we can see the volatility in the quarterly results and the effects of COVID-19 and restrictions throughout the year. But I guess we're finishing the last piece of the puzzle and giving you a result for the year 2020. So while the domestic sectors were affected severely by COVID-19, the M&E sectors grew quite strongly throughout 2020. So I'll look at the year's results first, and then I'll go in and look at the new quarterly data. So with the addition of the fourth quarter, the outturn for the year for GDP is an increase of 3.4%. I think most analysts were expecting something similar to that, and we have GNP up marginally at 0.6%. Really important with this morning's results is to remember that these are preliminary results for the year. When revisions and updates to our data are taken on board with the annual publication mid-year, the National Income and Expenditure, we'll have a new time series for you. So these are preliminary results for the year. Something else that many of you do at this stage of the year is look at the current price GDP data as a denominator for a lot of different things. So one thing, for example, is government debt. So if you take the Q3 debt numbers with this new GDP number of 366 billion, it's still at about 62% of a debt to GDP ratio. But my government colleagues will have more for you on that with their publication in April. If we take that GDP growth figure for Ireland of 3.4% and compare it to our European peers that are available, the results are available at this stage, you see that Ireland's the only economy growing in the data for the year 2020. And it shows you the two-track economy we have with very strong multinational results, particularly pharma and ICT, growing with the COVID crisis, and the other domestic sectors that have fallen perhaps more like a lot of our European peers' data. If we look at the size of the sectors there in the bar, and underneath is the growth rate for them, we can see for the year 2020 that the growth in industry, the biggest sector, and information and communication, the second biggest sector, both growing in the teens. While typically more domestic sector, distribution, transport, hotels and restaurants has fallen back 16.7%. Professional admin and support services is also down largely 15.5%, but some of that is also affected by aircraft leasing. A much smaller sector, but at the other end of the scale, we've arts, entertainment, and other services down significantly, 54.4% for the year 2020 over 2019. We can look at these sectors indexed to 2014. If you go onto the website, in the new format publication, you can toggle on and off all these series. So you can turn off the sectors perhaps that you don't want to look at, and you can kind of see a clearer picture there when we can see the two M&E dominated sectors, industry and ICT, growing, while the more domestic facing sectors falling into 2020, construction, distribution, transport, hotels and restaurants, and arts and entertainment. If we move from the GDP by sector over to the GDP by expenditure method, this stacked bar chart's showing you the components of GDP over time. So consumption, government spending, investment or gross fixed capital formation, and net exports. One of the difficulties I think a lot of people have with the GDP numbers is looking at the effects of IP and how it causes those swings between capital formation and net exports. So again, with the website version, you can toggle off the volatile series, and you can look at the GDP growth rate of 3.4%. We have a PCE fall in 2020 of -9%. And then if you build up PCE and government spending, then modified capital formation, you get up to the blue line there in the middle, which is modified domestic demand. So the modified domestic demand figure for 2020 is -5.4%. So you can compare that modified figure of -5.4% to the GDP increase for the year of 3.4%. Similarly, we typically do this. We take the GDP growth rate and we proportionally allocate it to the modified measure and the rest to net exports. And that gives you, from the expenditure side, a decomposition into a kind of a domestic and a foreign element. So you can see in 2020 that the domestic element, modified domestic demand, fell, while the net exports element increased and added to GDP. Working our way through the expenditure components, net exports has a lot of volatility in the data. That's the yellow line for net exports, and that's affected by the large increases each year in green for imports, or particularly imports of IP. But I'll leave that to John to talk to you a little bit more about the imports and exports data. The other elements of the expenditure side is investment or capital formation. And that's down 32.3%, largely because of the lower imports of IP in 2020 compared to the very high year we had in 2019. I'll just flick forward to that and come back. So it's that yellow amount on the stacked bar chart here for intangibles. So a lot of the comparisons here of 2020 over 2019 are difficult because of this big drop in IP in 2020. So there's still a lot of IP coming in 2020, just lower than what we had in 2019. So that, just keep that in mind as we're working down through some of these numbers. So if we look at building and construction, that's down 9.1% in 2020. New dwellings is down 2.3, but there's a much bigger weight, at least at the moment, there's a much bigger weight on all other building and construction. That's down 10.3%, giving us the overall effect on building and construction for the year. The remaining cap form is down 36.9%, but again, please keep in mind the effect of IP on the data. And we also have the typical aircraft effect on the data. So if we factor out aircraft for 2020 over 2019, it would be up marginally. So machinery and equipment would be up 0.1% if aircraft were unchanged between 19 and 20. If we move to the other element, the last element of the expenditure method, personal consumption, that's down 9% for 2020 over 2019, with goods down 5%, 5.1%, and services down 11.8%. So throughout the year, we've been telling you about the main items in consumption that are down. The biggest effect is on foreign travel. So consumption abroad is down, and on public transport. So both of those have been down consistently through the 4 quarters of 2020, giving us the annual effects we see here. There's some other movement in other services and other personal services. And some services are up, including communications in the quarter, or in the year 2020. If we finish then on the annual results with GDP at 357 billion, GNP, and we take off the net factor flows, the net factor flows have gone up from 82 to 90 billion in 2020. So taking off those higher net factor flows gives us a GNP figure of 266 billion. And that's where we get the GNP growth rate from 0.6% for 2020 over 2019. So for the annual summary, GDP now with the 4th quarter result in gives us a result of 3.4%. And we look across the sectors, we see that the multinational dominated sectors are up strongly, industry and ICT, while some of the more domestic facing sectors are down, distribution, transport, hotels, restaurants, construction, professional admin, these are all down. And with the net factor outflows increasing to 90 billion, that gives us our GNP growth rate of 0.6%. And on the expenditure side, consumption is down 9%. Government expenditure with COVID-related spending is up 9.8%. Investment is down and net exports are up, but again, that's related somewhat to the IP story. And when we factor out IP and aircraft, we can use our modified domestic demand measure, which shows us a result of minus 5.4% for 2020 over 2019. And then to look at the new information we have today on Q4. So Q4 seasonally adjusted data over Q3. We have the GDP growth rate down 5.1%. Going through the sectors on that, industry is down marginally. The big sector down is information and communications. So there's some volatility in this sector between Q3 and Q4, some timing issues around royalties, imports. And that's what's causing the fall in GDP in that particular sector. And consequently also what's causing the rise in GNP in the 4th quarter. I'll talk a bit more about that in a moment. A big rise or bounce back, I guess, in construction of 16.5% in the quarter. On the expenditure side of the accounts, again, imports are up quite strongly, and so is investment. That's an IP story again in Q4. Government expenditures up marginally in Q4, and personal consumption with the increased restrictions in November is down at 2.3%. So taking personal consumption and government spending and the modified investment, that's what gives us our modified domestic demand figure for the quarter, and that's down 2.2%. So we're comparing the modified demand measure, the domestic facing measure, down 2.2% compared to the GDP number, which is down a little further at 5.1%, mainly affected by the ICT sector. And we can draw that out a little bit here. I think many of you look at the GDP growth rate at minus 5.1% now in Q4 and compare it across some of the quarters. So the pattern of the GDP fall in Q1 and Q2 may not be what people expect. And we can explain that now with some of the M&A activity on the next couple of slides. But it has the result I think a lot of people were expecting in Q3 and perhaps a further fall in Q4. That we might have thought, mainly because of M&E activity. And similarly, that increased royalties payments in the ICT sector has meant that there's lower profit outflows and a higher GNP figure for Q4. So if you were to look at GNP across Q3 and Q4, you might get a better idea of the multinational kind of profit-free measure of the economy, GNP, if you look across the two quarters. But taking that official result, GDP of minus 5.1%, and comparing it to our European peers, we're actually on the left-hand side here. So close to Austria and Italy, but very much an outlier, probably because of the M&E activity in the quarter. If we look across the GDP by sectors or the output method, I summarized these in the infographic, but industry is down marginally, but the big story is probably on the ICT sector. So that's a 15 billion euro sector, down in Q4 2020, down at 16.5%. If we move or look at the sectors rather across time, again, indexed to Q1 2018, we can see the explanation, I guess. Again, on the website, you can go in and toggle these and take off some of the detail and make the chart a little bit clearer. And you can choose your own sectors, I guess, on the website. We can see the M&E activity on the top for the ICT and for industry. And then we can see the domestic facing sectors, the increase there in construction. And the smaller fall, I guess, in distribution, transport, hotels, and restaurants because of the November restrictions. And we can see that the fall throughout the year in arts, entertainment, and other services. But do keep in mind that rise in the ICT sector last quarter and the fall this quarter, that perhaps it's best to look at the two of those together. If we look at some of the higher frequency data CSO produces in relation to today's results, so the sector level detail, monthly manufacturing, you might have been wondering how the surge we saw in November and the fall into December. Again, these are probably related to kind of timing effects with any M&E activity rather than the traditional sector here across the 2 months. And you see for our industry result, of minus 0.1%, that it hasn't really affected the quarter. In terms of services, we see accommodation and food services down in October and November, and back quite strongly in December. And similarly with other services, a rebound on other services in December. On the expenditure side of the data for the quarter, again, as I explained with the annual results, IP imports affects the net exports figure here in green at the bottom, and the yellow capital formation figures, and cause a little bit of volatility in the data. So the GDP result being down 5.1%, we can take off the M&E elements, I guess, to that data. And we can look at consumption, which is down 2.3% in the quarter. We can look at government spending and modified capital formation to get, again, our modified domestic demand figure there in the blue line in the middle. On a quarterly basis, that's down 2.2%. So if we look at modified domestic demand, that blue line in the middle, as a yardstick for the economy, that's kind of giving us the result that we were expecting with COVID throughout the quarter. So Q1 is down 1.8%. Q2 is down 14.8%. Q3 is up 18.8%, and Q4 is down 2.2%. So a small fall in Q1, a big fall in Q2, the recovery in Q3, and a small fall in Q4. So modified domestic demand is giving us the kind of results we're expecting, or the yardstick that we were looking for to help us measure the domestic economy. Looking at the elements of expenditure, personal consumption is down 2.3%, largely services related in Q4, down 3.6%. And if we look at that personal consumption amongst our European peers, that minus 2.3% is in the middle. So this is individual consumption, household, and NPISH, which is charities, non-profit institutions serving households. This is the European measure for what we call personal consumption expenditure, and we're right in the middle of the pack, I guess, of European peers. Similarly, if we look at some of the more high-frequency data CSO produces, and see how it compares to our quarterly results today. Retail sales for the quarter is relatively flat. The fall in November and the increase in December helps explain maybe our quarterly result. But we can see within the quarter the differences because of the November, the restrictions in November, and the loosening of those restrictions in December, and particularly on the clothing, furniture, and department stores. We can also look at the proportion of online sales that's captured in our retail sales index, and the growth in that data in November with the restrictions, and the fall back again into December when restrictions were temporarily lifted. And the overall retail sales gives us a pretty good picture on a monthly basis of consumption, the falls mid-year and the falls again in November with the restrictions. If we look at net exports, I leave the detail on this to John to explain to you. But the big figure here, I guess, is the imports of services and how IP is affecting the net exports. So that's how the net exports are affecting the expenditure method of GDP. And we have the data shown here in constant prices seasonally adjusted. When we look at those net exports against modified domestic demand in the quarter, this again is using the weights for modified domestic demand and net exports to allocate the GDP growth rate. We have a minus 5.1% GDP growth rate, and we can see that the domestic element to that is actually quite small in the quarter. So for Q4, the domestic component of the economy has fallen a lot less than the overall result for GDP. And I think that puts the green part here for domestic demand, a small fall in Q1, the big fall in Q2, the recovery in Q3, and a smaller fall in Q4 is the kind of picture we're expecting. And then we can wrap around the M&E activity on this with the blue parts to the stack bar chart. And that explains the transition from the GDP numbers down to the domestic element in modified domestic demand. The volatile parts are the capital formation where the IP is. Because of suppression on the data in the quarter, we can't give out too much detail on capital formation. But building and construction, the key figure there that we can give out is up 15.6% in Q4 over Q3. We can look at that data across time. Again, the suppression affects Q1 and Q4. Mainly because of IP in those quarters. And we can, if you go onto the website, you can turn off the series that you don't want to see and look at the elements you do, for example, building construction across time. So in the quarterly results for GDP, it's down 5.1%. The M&E profits, the large M&E profits we saw in Q3 of 30 billion have come back to 20 billion, like we've seen in previous quarters. So that reduction in profits, mainly related to the ICT sector, has meant a very strong GNP result in Q4 of plus 8.5%. So just to finish on some new material that we have today. This is the release we normally bring out in a couple of weeks' time with M&E dominated sectors and what the share of the economy is for the M&E dominated data. So on an annual basis, the M&E data for 2020 is up 18.2%. This is seasonally adjusted, sorry, this is constant price data annually is up 18.2%, while the domestic or other sectors are down 9.5% in the year. One interesting point to note, I guess, is with the fall in the domestic economy in 2020, the M&E data as a share of value added now is 50%. So 50% or half of the economy is now dominated by these M&E. So the M&E dominated sectors make up 50% of the economy in 2020. On a quarterly basis, we can do the same thing and look at the M&E activity. So this, while modified domestic demand looked at the data from the expenditure approach, this looks at the output approach to GDP and picking sectors. And the M&E dominated sectors, we saw the growth in Q1 and Q3 and the fall in Q4 for the M&E dominated sectors, leaving the other sectors with the big fall in Q2 and the rebound in Q3. Another new element that you perhaps haven't seen before is a chapter now on compensation of employees or wages. And this takes data from the income approach to GDP. So typically for the quarterly data, we show you output and expenditure. There's also an income method we can develop. And this has one of the elements of income, which is wages and profits. This is wages. So we thought this would be very useful for a domestic indicator to look at wages on a quarterly basis. It's in development, this chapter, so it's in current prices and seasonally adjusted. It uses the new revenue PAYE modernization data, PMOD, and a min data source combined with the CSO's labor force survey, which talks about employment numbers, and our EHEX or earnings hours and employment cost survey, which gives us the wage rates. So the numbers and the wage rates gives us our wage bill. That's what the COE data is. And what this is showing us for 2020 is that the wage bill for the ICT sector on the far right there is up 8.9% in current prices over 2019. And on the other side of the scale, the much smaller sector, arts, entertainment, and other services, is down 15.1%, the wage bill there over 2019. So the chapter has the weights or the sizes of all of these sectors and much more detail in it. But that's just a sample, this chart of what we might be able to do with the wages data as a domestic indicator on a quarterly basis going forward. So just to summarize the quarterly results, we have GDP down 5.1%, with growth in the M&E sectors industry is flat, and the information communication sector is down 16.5%. That's what's giving us the overall effect on GDP of minus 5.1%. There is growth in domestic sectors of construction rebounding in the quarter, but it's mainly the lower profit outflows, net factor outflows down to 20 billion from 30 the previous quarter. It's given us this rebound in GNP of 8.5%. On the expenditure side of the accounts, consumption is down 2.3%. Government expenditure is up marginally 0.1%. And with the volatility of the imports data, we can factor out IP and aircraft and look at a modified domestic demand measure down 2.2%, very similar to the domestic consumption data down 2.3%. So at this point, I'll hand you over to John for the international accounts.
Thank you, Chris. I'll take you through now the international accounts for Q4 2020, and we'll take a preliminary look at 2020 as a whole. So this is our infographic, which gives a good summary of the results for Q4. So we can see our goods surplus of 34.2 billion, our services deficit of 5.6 billion, and our net income outflows of 21.5 billion, which all combine to give us our current account balance of 7.1 billion euros or 7.5% of GDP. And when we look at how this is funded, we have a net international investment position of minus 615 billion and foreign direct investment in Ireland stocks of 1.1 trillion euros. To look at 2020 as a whole, we can see that the current account balance for 2020 is 16.9 billion, which is up 57 billion on the 2019 figure. but this is largely driven by the difference in IP imports between the 2 years. And we'll see that a lot through the results. So our merchandise surplus is 138.8 billion, which is up 19.6 billion on last year. Our services balance is minus 28.9 billion, which is up 46.4 billion on the minus 75.3 billion last year, again, driven by IP. And our net income outflow stands at 92.9 billion, which is up 8.7 billion on 84.2 billion last year. To look at our headline figure, which is the current account balance as a percentage of GDP, we can see quite sharply here the quarters where we have large IP imports, where the current account is largely drawn down. But we can see the last 3 quarters have had lower levels of IP, with a small amount of IP in this quarter, but not on the same levels as previous quarters. To break this down again into a bit more detail, we can see that the current account balance for Q4 is 7.1 billion, which is up 36 billion on the same time last year, which is again driven by differences in IP imports between the 2 quarters. Our merchandise surplus stands at 34.2 billion, which is up 5 billion on the same time last year. And our services deficit is 5.6 billion, which is down 32 billion on the deficit of 37.3 billion last year. And again, this is driven by IP. Our net income outflow stands at 21.5 billion, which is up 1 billion on last year's 20.4 billion. But this is, there's larger variation between Q3 and Q4. So we look at that a little later. Looking at our balance over time, again, we can see the quarters with strong IP imports have the large negative services balance and the lower than usual balance on the current account. So looking at this quarter versus the last quarter, we can see that our merchandise are down. Our services balance has gone from positive to negative, driven by smaller IP imports, but some IP imports. And our net factor outflow is down as well. And all of these combined give a current account balance that's down 5.6 billion. Looking at the Q4 in a little more detail, we can see that our merchandise exports stand at 62.1 billion, which is up nearly 3 billion on the same time last year, while our merchandise imports stand at 28 billion, which is down 2 billion on the same time last year. For the services, our exports are 71.7 billion, which is up 9.1 billion on the same time last year, while our imports are 77.3 billion, which is down 22.7 billion on last year. But again, this is largely due to IP. The primary income inflows stand at 21.8 billion, which is down 4 billion on the same time last year, while the outflows stand at 42.4 billion, or 42.2 billion, sorry, which is down 3.5 billion on the same time last year, which give us the net change of 1 billion. Looking at direct investment profit and interest inflows, they stand at 4.1 billion, which is down 767 million on last year, while our outflows stand at 22.4 billion, which are up 97 million on the same time last year. Looking at our goods, imports and exports in a little more detail, we can see that the exports for Q4 are up compared to Q3 2020 and are also up compared to Q4 2019, while our goods imports are up on last quarter, but down compared to the same quarter last year, which is a similar pattern that we saw in Q3 compared to Q3 2019. Looking at the split out of our merchandise into international trade and the other, and goods for processing and the other areas, we can see that the international trade exports are down quarter on quarter and down year on year, while the goods for processing exports are up quarter on quarter and up year on year. When we look at the import side, the international trade imports are up quarter on quarter in a similar pattern to last year and up year on year slightly. Looking at the imports of goods for processing, we can see that they're up quarter on quarter again in a similar pattern to last year and are down year on year. To look a little more closely at our services, on the export side, we have an overall increase of 9.1 billion compared to the same quarter last year. And we can see here that this is largely driven by increase in computer services, which increased by 6.7 billion compared to the same time last year. We also have an increase in business services of 1.4 billion. and we can see the continuing effects of COVID on the tourism and travel services and the transport services, which are down $1 billion and $1.4 billion respectively. Looking at the import side, we can see that we have an overall decrease of 22.7 billion compared to the same quarter last year. And we can see that this is largely driven by the decrease in business services of 29.9 billion, which is mainly due to IP. We can also see an increase in royalties and licenses of 7 billion. And again, we can see the continued COVID effects in the reduction in tourism and travel of 1.9 billion compared to the same quarter last year. To look at that royalties change in a little more detail, we can see here the total royalty imports, and the green bar is the pharmaceutical royalty imports. So we can see that there was a high point in Q4 2019, and we've had a downward trend since then, but we've had a large increase in this quarter. But we can see that this is not being driven by the pharmaceutical sector, but is instead being driven by the other sectors, which includes ICT. This increase is partially due to royalty payments made in Q4, which are also related to other quarters, as Chris mentioned earlier. Looking at direct investment income, we can see that the inflows stand at 4.1 billion, which is down 767 compared to the same time last year, while our outflows stand at 22.4 billion, which is roughly the same year on year. However, our quarter on quarter net is down 8.2 billion. This is partially due to the increase in royalties this quarter that we saw on the previous slide, but it's also due to reduced profits across some sectors this quarter. Looking at the breakdown of our direct investment outflows, we can see that the income on debt is fairly flat. The dividends and distributed branch profits are following the same Q2 to Q4 pattern as previous years. So the difference is predominantly in the reinvested earnings. Looking at this again in a little more detail, we can see the quarterly profits outflows here split into manufacturing and information and communications. So we can see that the decrease is in the manufacturing sector and the information and communication sector. It's spread across the two, but manufacturing down 4.9 billion and ICT down 3 billion. However, both are up compared to the same quarter last year, with manufacturing up 1.7 billion and ICT up 1.3 billion. So now to look at our current account with the UK, the trade balance with the UK has decreased by 318 million and net income outflows have decreased by 507 million compared with the fourth quarter of 2019. The result is a current account surplus of 146 million in the fourth quarter of 2020, up 189 million from the deficit of 43 million in the fourth quarter of 2019. Looking at the financing, we can see that we're not getting the same large net transactions that we've had in previous quarters, that it's a fairly quiet quarter. We have net increases in portfolio investment and in net decreases in other investments. And looking at our net international investment position, we can see that there have been changes in a few sectors in different directions, but the overall effect is a change in our net international investment position of 13 billion, changing it from minus 602 billion to minus 615 billion. So to summarize, we have a current account balance in Q4 2020 of 7.1 billion or 7.5% of GDP. The current account balance for 2020 stands at 16.9 billion. Notable this quarter are the increase in royalty imports and the exports of computer services, as well as the decrease in net profit outflows. And our COVID-19 effects continue into Q4 2020 with our lower tourism exports and imports, largely netting out for the current account, and lower transport services exports. So I'd like to hand you back to Jennifer now to summarize.
John, thanks very much for that, and thanks to Chris as well. So look, just on the headline results for the year, we'll focus on 2020 because I think Chris and John have taken you through the variation there that we've seen in the underlying quarters. So GDP increased by 3.4% in 2020. We've seen the strong performance of the multinational sectors and offset by the variation in contraction and expansion in the domestic sectors, leading to that overall growth in the year. GMP grew by 0.6%. Again, the explanations are there around the strong profit outflows for the multinational sectors in 2020. The modified domestic demand indicator, which brings us further down into the economy and measures personal, government and investment spending, decreased by 5.4% in 2020 over 2019. And I think it's an important indicator, particularly as we come to the end of 2020 and we're looking at those different patterns of IP relocations into Ireland over 2019 and 2020. I think the modified domestic demand indicator is particularly useful to understand the underlying activity in 2020. And then to go right down to personal consumption expenditure, which is what we all spend on our goods and services. We see overall for the year a contraction there, a decrease of 9% in 2020 for personal consumption and expenditure. So many thanks to presenters today.